Hey guys, what's going on? It's Rekt Capital and welcome back to the Rekt Capital channel. Thanks so much for joining me in today's video. I hope you're having a wonderful day, wherever you are in the world. Let's talk about the death cross, of course, but through the lens of the stock to flow model. Can the death cross actually invalidate the stock to flow model? Subscribe to the channel for more videos like this in the future, and let's dive right in. So let's talk about a historical analysis very briefly, because I did share a thread on this, and of course I did also create a video about this, so check the video out if you've missed it. But in any case, a very brief historical analysis of previous death crosses in Bitcoin's price action. We have to go back all the way to 2014 for the first meaningful death cross, really. In the 133 days since the peak of that 2013 December bull market, we saw a crash until the first death cross occurred, and then we see a 71% crash afterwards, after that death cross occurs. And of course you do see a death cross over here and then a relief rally in the price action, but then the death cross actually occurs later on. So overall 71% crash, confirmation of further downside after the death cross. In December 2017, when we peaked, it took over 3 months for Bitcoin to achieve its death cross, and when it did achieve the death cross, and you can see here the death cross happens over here, and then we see that death cross kind of tease, these two EMAs align with one another, so really that death cross is valid since here. And then we see the death cross continue, so an additional 65% crash on top of what crash we saw over here, right? So that's an additional downside of 65% to the bottom in 2018, mid-December. And here's another death cross to mention. 150 days since the peak in June 2019. A crash of 55% after that confirmed death cross. And here, it's a bit of a difficult one, and I actually want to touch upon this very briefly. Breaking down, so this death cross occurs, we see some downside, and then we see a relief rally, and then that death cross turns into a golden cross, and then another death cross happens once we get that crash, and then another golden cross. So lots of really tough here. And you see how the 50 EMA with the 200 EMA, so the 50 is the blue one, 50 EMA, and the black one is the 200 EMA. And you see during this entire period where we're kind of in an accumulation range, right? With downside, a bit of downside, a bit of relief rallying, about downside a bit more, even though this was the March 2020 crash. So you see a really strong crash here. Generally speaking, this is kind of your accumulation range. And during an accumulation range, you notice how these two EMAs are really close to one another. They're very much converged. Comparing, for instance, to the time where you see a peak and you see the EMAs being really far apart from one another. So these tend to be valid death crosses. So the larger the gap between these two EMAs, the more likely that death cross is actually going to be quite substantial. And that's a point that I just want to make, because many people are saying that in March 2020, if you sold the death cross, you would have sold the bottom before that really phenomenal bull run that we've enjoyed. But of course, that's just one apologies. That's just one data point. And it does come in a period of accumulation, macro accumulation before the next macro uptrend. And this is where these EMAs are really closely converging. So loads of those meaningless crosses can occur during this time, but the most meaningful crosses, death cross or golden crosses, occur when we get this, we have this tremendous space between the two EMAs, and then they start to converge rapidly with a acceleration almost to just cross and confirm additional downside. And the same thing can be said about golden crosses over here. You see a lot of space between these two EMAs before they converge and then cross over into a meaningful new trend. So it's these spaces between the EMAs that just start to narrow very quickly and then finally converge to cross over into a def or golden cross. And it's this sort of acceleration in those EMAs converging for that crossover that precedes the new trend, whether that's towards the downside in a confirmed def cross or ever towards the upside in a confirmed golden cross. So I just wanted to touch upon that because this is one data point, and we really need to look at the historical viewpoint of def crosses overall, and the fact that these spaces between the two EMAs do matter, because we tend to see these spaces wider at the end of trends before we see confirmed trends, whether that's a downside for the def cross. But in ranging periods near the bottom of markets, you tend to see these EMAs just cross over all the time because you don't see much fluctuation in price action. There isn't much volatility. There's a bit of downside, a bit of upside, a bit of downside. So these EMAs, having converged already quite a lot, they tend to just get muddled up. So that EMA strategy isn't really a clear signal in times of really unclear price action, which is, you don't really see much volatility here, just kind of, I hope that's clear about that. That's my view on those EMAs in any case. So in any case, right now we're seeing really, there's this gap that I mentioned, right? And this gap is starting to narrow down as these two EMAs are starting to converge, and they're converging rapidly. You're seeing these two EMAs really declining because Bitcoin hasn't been doing anything. And this is a chart from May 31st, in fact, and it's already, well into the first week of June, and we're still around the same price point. So this def cross is still really on track to just cross over in mid-June. And unless Bitcoin can do something, significantly, then we're going to get that def cross. The point here isn't, it's not necessarily that we're not going to, it's quite likely we're going to see that def cross. What is unlikely, or rather what isn't quite clear, is how price will react to that def cross, because of course in the past you have seen these def crosses not amount to much, but after tremendous gaps between these EMAs which start to converge, you tend to see confirmed further downside, and that does look like Bitcoin could see that confirmed further downside as long as it loses this key support. So really important to watch out for that def cross, and then watch out for any weakness in Bitcoin's price action. But in any case, guys, that was a very detailed look at historical def crosses, but also the meaningful ones versus the ones that have a lesser signal in consolidation periods at market lows versus periods of def crossing at market highs. Very different market context, and so very different def crosses. But I just want to talk about the def cross through the lens of the stock to flow model, and it's really important to just mention how these def crosses play into the stock to flow model. And the very basic question here, will the def cross invalidate the stock to flow model? The answer to that question is no, categorically no, because def crosses as well as golden crosses are uptrends and downtrends, and they occur in any market cycle. So there's no need to be bearish or at least panicky about the def cross ending a long-standing indicator that is the stock to flow model, which has been a reliable predictor of Bitcoin's price action. A def cross won't change that necessarily. It's just going to dictate where in the context of the stock to flow model will Bitcoin's price action behave. So back in 2011, we saw a def cross occur near the market lows. We didn't have much price action at that time, so it's not the most important def cross to really focus on. It's better to focus on def crosses that are more mature, have more price action to aid those crosses. So in this portion of the market cycle, or at least in Bitcoin's price history, we didn't really see much price action. And so this def cross, which occurred around this period, roughly speaking, it occurred not too far away from the actual market bottom. Of course, we did see some downside, but in any case, the most important thing to bear in mind in the context of the stock to flow model is that this def cross, when it happened, we saw downside below the stock to flow line. And very, very simply, in the context of the stock to flow model, Bitcoin's price above the stock to flow line is where we're seeing an overextended bull market. And below the stock to flow line, we're seeing an overextended bear market or downtrend. So right over here, whenever we see that death cross occur during this period and we see price decline below the stock to flow line, we're entering an oversold region where we're entering and reaching the maximum point of financial opportunity. And conversely, if we deviate towards the upside beyond the stock to flow line, then that's where we're entering the point of maximum financial risk because we're overextending in that bull market. So here's the next period, and probably one of the more similar periods to what we're seeing right now, where in 2013 we get that mid-cycle crash, but the only difference in that mid-cycle crash in 2013 is we overextended beyond the stock to flow line, overextended in the bull market, and then crashed to turn the stock to flow line into a support before continuing towards the upside. Now that's quite similar. We're quite similar in terms of the mid-cycle in 2013 to what we're seeing right now, but the difference is that we're seeing the stock to flow line, actually Bitcoin below the stock to flow line. So even though we're seeing a mid-cycle crash in 2021, much like we saw a mid-cycle crash in 2013, Bitcoin was above the stock to flow line in 2013 during this mid-cycle crash, and Bitcoin is actually below the stock to flow line during this mid-cycle crash. So there is a difference, a big difference there, because I did compare the 2013 and 2021 cycles in a previous video, and feel free to check that one out because it's quite interesting. But this is a major difference if we look at these two mid-cycle crashes and compare these two bull markets, because they're very different in the context of the stock to flow model, even though they're quite similar in different ways that I spoke about in a different video. But anyway, getting back to the death crosses, we're covering a lot of things here, so I hope you guys are enjoying the video. Subscribe to the channel for more videos like this in the future, and like the video if you're enjoying it so far. In any case, when we got that bull market peak in 2013, we got that death cross finally, and then that death cross really proceeded downside. And once again, you're seeing that we're in a period of overextension in the bull market, maximum financial risk, the death cross occurs, and then we pull back below the stock to flow model, and we're back at that point of maximum financial opportunity, right? Because very simply, above the stock to flow line, overbought. Too many people are buying, and we're going to see a bull market top sooner rather than later. And if we're below the stock to flow line, then we're getting to the point of overselling. Too many people are selling, and we're getting to that point of extreme fear and maximum pessimism, which precedes maximum financial opportunity. So this death cross got price back below the stock to flow line for a fantastic accumulation period, and we were below this point, so maximum financial opportunity. Similar thing here, death cross occurs above the stock to flow line, and then we enter that period of maximum financial opportunity below the stock to flow line, bottom out for an accumulation range, and then enter the new trend. And here is where we see those death crosses that don't really amount to much, where we see a lot of that converging happening, crossing over, resulting in meaningless kind of trends. We don't see really substantial death crosses happening here because it's a period of general macro accumulation. So you see these death crosses happen here. And if we just zoom in here, the death cross that happens over here after that 13,900 peak in June 2019, you see price go below the stock to flow line a bit. And then we recover, and then we get another death cross, which brings price below the stock to flow line yet again for a great outsized opportunity in the context of the stock to flow line. So this principle that I'm just sharing with you, the death cross in the context of the stock to flow model, holds very true across time. But of course, you're seeing here that this is now the exception to that rule, because you're seeing the death cross potentially happen. It doesn't have to happen, it could happen, and if it does happen, does that mean we're going to see confirmed downside? Probabilistically speaking, it is quite likely that we'll see further downside because we're not in an accumulation region at lows of the Bitcoin market cycle. We are in a period where we've overextended towards the upside quite significantly, and we have those two EMAs quite wide from each other, and now they're converging rapidly. So the market cycle right here is very different to the market cycle right here. So a death cross could potentially occur, but the difference here is that Bitcoin's price action is below the stock to flow line. And just to look on the history of Bitcoin trend following the stock to flow line, you can see right over here that Bitcoin's price action is following the stock to flow line quite closely, almost perfectly, for many months. And we actually don't see that in previous bull cycles, right? You don't really see perfect alignment with the stock to flow line. You just generally see deviations towards the upside or deviations towards the downside, whereas here, for the first time ever, we're actually on track, or at least trend following the stock to flow line, which is in of itself an outlier. And because we were trend following like this, we're now getting to the point where a potential death cross is occurring when Bitcoin's price action is below the stock to flow line. And if we weren't outpacing the stock to flow line, or at least outpacing the market cycle itself, because we did get tremendous buy side momentum here, in normal conditions, if it wasn't such an exuberant market, we'd just be continuing below the stock to flow line, and we'd be below the stock to flow line and just continue to be that way. But we were actually trend following for a while, and now we're below it again. So in any case, theoretically, yes, a death cross could be occurring, but also theoretically, through the lens of the stock to flow model, because we're below the stock to flow line, we're getting to the point where it's worth watching out for. Where could we form a accumulation range, whether that's at lower prices or whether it's at current prices, if the death cross gets avoided some way. But in any case, because we're stuck below the stock to flow line, historically being below the stock to flow line has been a great point of financial opportunity. So it's really important to watch out for where could Bitcoin build out a base and form a consolidation range, an accumulation range, even though that death cross happens and we see a bit more downside. Because if that death cross happens, and historically we see a lot more downside happen, let's say we get to this point, wherever the case may be, being below the stock to flow line, that's still great to be watching out for those financial opportunities. Because over time, whether we bottom here, or bottom here, we're still below the stock to flow line. And historically, we tend to just recover and deviate above the stock to flow line in of itself to reach a Bitcoin bull market peak. And this would probably tie in with the Bitcoin logarithmic growth curves, which I spoke about in a previous video. So all these different perspectives are gelling together, and we're seeing a lot of confluence there. So really interesting. Where could we bottom? Because the stock to flow model is suggesting to us that we are entering the point of increasingly interesting financial opportunity, but where could we bottom? Where will the maximum point of financial opportunity be? That's something to bear in mind. But in any case, if a death cross happens, and it is quite likely that will happen, it won't invalidate, apologies. Once again, a death cross will not invalidate the stock to flow model. It will just likely confirm a trend in the context of the stock to flow model. So a death cross would probably confirm a bit more downside before we finally begin that next uptrend to continue the second half of the cycle and then deviate beyond the stock to flow model, the stock to flow line, to perform a deviation towards the upside beyond the stock to flow line, and then finally top out in that Bitcoin bull market somewhere above the stock to flow line. And that's about it for today's video update. I hope you enjoyed the video. Leave a like if you enjoyed it, and of course subscribe to the channel for more videos like this in the future. Thanks so much for joining me today. I'm Rekt Capital, and I'll speak to you in the next one. Speak to you soon.